Alright everyone, this is Ali Mama Sheikh. We are starting a new topic today, that is trade receivables. There are different concepts related to this trade receivable. Number one, who are actually trade receivables. Number two, irrecoverable debts or bad debts. Number three, bad debt recovered. And number four, provision for doubtful debts. So who are trade receivables? They are the people who owes the business. Whenever business makes sales on credit, other person becomes your trade receivable. And until they pay you back the amount, till then they will call current assets of the business because they owe you. You have to receive amount in the future. Next concept is irrecoverable debts. When a person notify you that he or she is unable to pay back the amount they owe, so you have to write off this amount under the heading of irrecoverable debts. It's a loss to the business. You are not going to recover the amount which is owed by the trade receivables. So you will charge it as an expense in the financial statements. So let's take an example over here to illustrate it better. Credit sales to Mr. A, $1,000. What journal entry you are going to pass? Number one, Mr. A debit, sales will be credited. You will draw a ledger account of Mr. A and a ledger of sales. Mr. A will be debited in the account by writing sales, and sales will be credited by $1,000. This is a simple entry to record credit sales in the ledgers or in journal entry. Let's continue with the same example. Mr. A has notified after a couple of months that he is unable to pay because he has gone bankrupt. So you need to write that amount off in the business in the financial statement. So it's an expense, it's irrecoverable debt. The journal entry you are going to pass is irrecoverable debt debit. Mr. A will be credited. The account of Mr. A is already there in the books, in the ledger. So in the Mr. A account, bad debt, irrecoverable debt will be credited, and you need to draw a new account of irrecoverable debt, and Mr. A will be debited in this particular account to record the bad debt expense of Mr. A. Now, how do we close the accounts of irrecoverable debt? The total of the debit side is 1,000, and total of the credit side should be the same. So there would be no balance CD, no balance BT in this account. The entire amount will be write off under the heading of income statement. So in this particular account, in irrecoverable debt account, if we do balance CD and balance BT, it means it's the amount that is carrying forward for the future. But it's not the case over here because the person has gone bankrupt, he is unable to pay you back. So the entire amount of this bad debt will be charged in income statement. So you are going to write off this amount by writing income statement and close the account. So I hope it's clear to all of you. Let's take another example. Sometimes receivers pay you certain amount and notify that a remaining amount cannot be paid. So in this particular case, I've written an example over here. That is, Mr. A has agreed to pay 0.5 cents for the amount he owes and excuse for the remainder balance. In this case, the amount he owed was $1,000 and you are going to get $0.5 for each dollar he owes. So you will get $500 in form of either cash or bank, and the remainder amount out of 1,000 would be charged as an irrecoverable debt. So in some of the cases, in some of the questions, they give you this particular adjustment as well. Some of the amount is received and the remainder is bad debts. The remainder is irrecoverable debts. How do we charge a journal entry over here? Cash or bank will be debited because the cash increases on the debit side. Irrecoverable debt, the remainder amount 500 will be credited. It's an expense. And Mr. A will be credited by $1,000. So I've made another ledger accounts of Mr. A and recoverable debts again. Mr. A's account sales was credited before with 1,000. Cash received 500 will be credited in Mr. A's account, and remainder irrecoverable debt will also be credited in Mr. A's account. The account will be balanced. In irrecoverable debt account, now Mr. A will be credited by only 500, not with 1,000, because 500 amount was received and the remainder was bad debt. And the entire amount will be write off against income statement. So there are two examples of bad debts, irrecoverable debts. In one, there would be a complete amount that is lost. In another one, there is some amount that is received and another remainder would be a bad debt, a recoverable debt amount. Okay, so I hope this concept is clear to all of you. Let's begin with the third concept, that is bad debt recovered. Bad debt recovered is opposite of irrecoverable debts or bad debts. In this scenario, previously written off receivables, previously written off bad debts, the people who owed you before and gone bankrupt, unable to pay you back, after a couple of years or couple of months, they are coming back and paying off the amount which they were owed before. So in this case, bad debt recovered would become an income for the business. How we are going to record this? Let's take an example. Let's say Mr. A, after a couple of years, came back and paid the amount he owes. So now, first entry you are going to make is to reinstate his balance in the books because it was previously written off. So in the first entry, I would reinstate the amount of Mr. A, the account of Mr. A, by debiting Mr. A by $1,000 and crediting bad debt recovered over here. So now, if I am recording bad debt recovered on the credit side, it means it's an income, and income always increases on the credit side. That's an accounting concept. So in the first entry, you are going to reinstate the balance of Mr. A in the books, and then the amount which is received in form of either cash or bank, it will be debited, and Mr. A will be credited by $1,000. So in bad debt recovered, the entry is opposite of that of bad debts. In this case, bad debt recovered is an income. You are going to pass two different journal entries. First, to reinstate the balance of Mr. A in the books, and another is to record the cash that is received from Mr. A. So in the account of Mr. A, bad debt recovered would be debited and cash or bank will be credited to balance of the account. In bad debt recovered was credited before. In journal entry, in the credit side, I will write Mr. A. And over here again there would be no balance CD, no balance BT. The entire amount will be write off against income statement. So the credit side should be balanced with the debit side. The entire $1,000 would become income statement amount and will be charged in other incomes after gross profit. So the accounting treatment of bad debt recovered is that is an expense, and accounting treatment of bad debt recovered is an income. It will be added to gross profit. After finding gross profit, you need to write an heading of other incomes, and then you need to write bad debt recovered in that particular heading. So I hope bad debt and bad debt recovered is clear to all of you. Now the last concept of this topic is provision for doubtful debt. What is provision for doubtful debt? Provision basically is an estimate that management think of to charge doubtful debt in the future of the business that is expected by the management. Let's take an example. If business is experiencing certain bad debts in the past, so there's a risk of bad debts in the future as well. That business management can think of okay, some receivables might go bankrupt, might not be able to pay you back. So over here the concept of provision would arise. Management would consider to charge a provision in the books on doubtful debts, that this particular receivables, this amount could be a doubtful amount that might be lost in the future. So according to accounting concepts, prudence concept, you can charge provision before if you think of that certain expenses might arise in the future, and arising of bad debt is an expense for the business, so you can charge provision, and it is called provision for doubtful debt in the books. So let's take an example. Provision is charged on the closing balance of trade receivables, and a certain percentage would be applied on the trade receivables. That is again a management's perception, how much percentage do they want to charge. There is no hard and fast rule. Sometimes management charge 2%, 3%, 5%. It's on their own wish. So after writing of bad debts, the closing balance, the balance CD of trade receivables will be applied with the percentage to charge provision for doubtful debt. Let's take an example again over here. I've assumed that in 2020 trade receivable balance is $20,000 and the provision for doubtful debt is charged at 2%. So provision for doubtful debt for this year would be 20,000 into 2%, you will get $400. Next year in 2021 the trade receivable balance stood at $24,000 and again the provision percentage was 2%. Now this year in 2021 provision for doubtful debt would be 24,000 multiplied by 2%, you will get $480. So now here's the catch. In this particular topic, when you find provision for doubtful debt, it needs to be compared with the last year balance. Over here the last year balance is $400 and this year it has become $480. So the risk of bad debts has increased because the provision has increased. Whenever provision increases, it's a risk that is increased, that is, this amount of receivables might get bad debt, might be irrecoverable for the business. So whenever there is an increase in provision for doubtful debt, increased by $80, it's an expense. Whenever provision for doubtful debt increases, the risk of bad debt increases, it will be charged as an expense in the books. So provision increases on the credit side. When you record provision for doubtful debt in a journal entry form, provision for doubtful debt will be credited by $80 and income statement will be debited by $80. Why? Whenever we debit income statement, it means it's an expense. So whenever provision for doubtful debt increases, it's an expense, and the journal entry to record this would be income statement debit and provision for doubtful debt will be credited by $80. And if they ask you to draw a ledger of provision for doubtful debt, the balance BD would be always on the credit side because there's a rule of provision. It always increases on credit and decreases on debit side. So in this particular example, the balance of, if we are drawing account for 2021, balance BD would be $400. Why? Because the last year provision was $400. And this particular year the provision has increased by 80. Whenever provision increases, income statement will be charged on the credit side. I hope you all know this concept. So to balance it off, the credit side total is $480. Debit side total should be also $480. This entire amount will be charged as balance carried down for the year 2021. Balance it off in 2022, write balance BD in the books with $480. So whenever you make a provision for doubtful debt account, it increases. If it increases, it will be recorded on the credit side. Credit side income statement means it's an increase, and if there is a decrease in provision for doubtful debt, it will be recorded on the debit side. So let's take an example. Let's continue the example. In 2022, they say the trade receivable balance is $22,000 with some bad debts which were not written off before, that is $1,000. Okay, so provision again is the same. Provision for doubtful debt is applied at 2%. So how do we find provision for doubtful debt for this year? Solution would be provision for doubtful debt $22,000 minus $1,000. I've assumed that bad debt not written off. So you need to write off bad debts first in order to apply the percentage. 22,000 minus 1,000 multiplied by 2%. Over here you will get $420. $21,000 into 2% would be $420. So again you need to compare this answer with the last year provision. In the 2021, the provision was $480, and in this year the provision is $420. So if you compare it with 2021, $480, and in 2022 the provision is now $420. So you can clearly see over here is that it is decreased by $60. So decrease means the risk of bad debts is reduced as compared to last year. So whenever the provision for doubtful debt decreases, it will be recorded as an income. Okay, and when you pass a journal entry over here, the journal entry would be provision increases on credit, and when it decreases, it will be recorded on the debit side. So provision for doubtful debt will be debited by $60, and income statement will be credited over here by $60. And income statement credit means it's an income for the business. After finding gross profit, you need to write this in other incomes as an decrease in provision for doubtful debts. I hope the concept is clear to all of you. So when you pass this entry in the journal in the ledger of the account, so I am using this space again. Let's continue with the same example, same question. I am writing this in provision for doubtful debt account. So in 2022, the balance BD is $480. I'm continuing with the same example, and in this year it is reduced, so income statement will be recorded on the debit side as an income by $60. So whenever whenever provision for doubtful debt increases, income statement will be recorded on the credit side, and when the provision for doubtful debt decreases, income statement will be recorded on the debit side. So now you need to balance it off. The total of the credit side is 480, should be equals to the debit side, and the remainder balance would become balance CD. 480 minus 60, you will get $420. In 2023, the balance BD would be $420. So this is how we solve provision for doubtful debt in any of the question. Balance BD would always be on the credit side. It's a provision account, the nature has to be credit. Whenever provision for doubtful debt increases as compared to last year, it will be recorded on the credit side as an income statement. And whenever provision for doubtful debt decreases as compared to last year, it will be recorded on the debit side. The journal entry to record increase is income statement debit, provision for doubtful debt credit. And the entry to record decrease in provision for doubtful debt, provision for doubtful debt will be debited, income statement will be credited. So I hope the concept is clear to all of you. Lastly, how do we present it in financial statements? So I am drawing extract of income statement. After gross profit, when you find gross profit in any question, we make a heading of other incomes. If there is a decrease in provision for doubtful debt, in other income you will write decrease in provision for doubtful debts. Okay, and if there is a increase in provision for doubtful debt, after gross profit we also make a column of expenses, less expenses. So in expense you will write increase in provision for doubtful debt. So either there would be any one of this entry that would be made in income statement in account for provision for doubtful debt. How do we present it in a statement of financial position? Extract of statement of financial position. Trade receivable is a current asset. So in the heading of current asset, let's say I'm making a transaction for 2021. In 2021, a statement of financial position, how do we present trade receivable balance? First write trade receivable. That was first column, second column. You can do this working in the second column. Trade receivable balance in 2021 was $24,000. Okay. Less provision for doubtful debt. Over here you need to put a total provision for doubtful debt amount. not the difference. Difference would only be for income statement, and in a statement of financial position you need to pick the total value of provision that was charged in that particular year. And in that question, in 2021, the provision for doubtful debt was $480. So you will deduct entire provision amount from your trade receivables. Why? Because the statement of financial position shows the closing balances of every period. So the closing balance of trade receivable provision was $480. So you need to deduct $480 from here in a statement of financial position and write your answer in the last column. So this is the extract of a statement of financial position. I am repeating it again. For income statement, you need to put the difference. If it's increasing, it's an expense. If it's decreasing, it's an income. But in a statement of financial position, under the heading of current assets, you need to deduct the entire provision for doubtful debt amount of that particular year from your trade receivables. Because in a statement of financial position, we always take closing balances at the end of the financial year. So there are 4 different concepts of trade receivables. Number 1, who are the trade receivables? Number 2, irrecoverable debts. Number 3, bad debt recovered. And lastly, provision for doubtful debts. You might be asked in the exam to draw journal entries. I've explained it. The journal entry of irrecoverable debts, the journal entry of bad debt recovered, the journal entry to record increase in provision, the journal entry to reduce decrease in provision for doubtful debts. And also they can ask you the ledger accounts of different scenarios like provision for doubtful debt account, bad debt account, or bad debt recovered account. So they can also ask you how to show it in income statement. So extract of income statement needs to be drawn. If it's a decrease in provision, it's a income, and it's increase in provision, it's an expense. And irrecoverable debt will also be charged as an expense. I'm writing it down again over here. In expense, you also need to show irrecoverable debts. And if there is a bad debt recovered, you need to show it in other incomes. Bad debt recovered. So now the lecture of this topic is completed. If you like this video, kindly like it, share it with your friends, with your family members, and do press the ring bell icon for upcoming videos. Thank you so much.